Hi, and welcome to the Stock Scores Market Minutes for May 1st, 2017. This week, the topic is Understanding Drawdown. We'll do the trade of the week at the end on Facebook, and in the middle, look at the markets and where they are likely to go in the weeks and months ahead. All right, let's get into this week's topic, Understanding Drawdown. For an individual trade, how far a position goes against you before it becomes profitable is the drawdown. So if let's say you buy a breakout from an ascending triangle, and the risk of that trade, we call that 1R. If it pulls back like that, let's say, then that would be a drawdown of 0.75 RR, because that's about 3/4 of that move. If it goes down all the way like this before it goes higher, well, that might be 2R down or 3. And that's something that you should consider for every trade. Calculate the drawdown before the trade starts to work. For a strategy, you will also go through periods when the strategy just doesn't work all that well. There's hot markets and there's weak markets. And so during these times, your overall strategy may lose and give you a drawdown. It could, if you have your equity curve, you could have the strategy kind of going like this and then have a period when it doesn't work before it starts to work again. Well, that is the drawdown. And how much does it lose against the overall profitability in those drawdown periods? Now, it's important to understand these concepts because it can help you to define your risk management. If on an individual stock you see that your winners consistently don't draw down more than -1 RR, then you'd set your stop just a little below that point. If, however, you find that many of the winners actually go down perhaps 1 or 2 RR, then you might want to allow your stops to be wider to give those winners the potential to move. So that's why you want to understand that on individual stocks. On a strategy idea, you want to maybe pull back the risk amount if you start to see drawdown accumulating over time so that you can minimize the overall drawdown effect. And also, it just helps to understand that, in the course of a year, you might have a month or two where you have a drawdown that is 10% of your overall gains, and to come to expect it so that when it does happen, you're not shocked and frustrated by it. All right, let's get into this week's analysis. Here is the 30-day, 60-minute chart of the S&P 500. The important thing that happened this week is we broke this downward trend line with a strong gap up. That came after the French election, took out a lot of the political risk in the market, and the market moved up quite nicely. It topped out right here, which basically corresponds to that inflection point high. And so we have pulled back since then. We are almost back to the upward trend line that's been building, and therefore we should bounce off of this, head back up to this inflection point top, and then get stuck there. That would be the all-time highs. So the momentum is good. I would say the risk isn't ideal because the move started down here. So we're getting a little late before it's going to hit resistance. So the upside is somewhat limited, but at least we're in a bullish short-term trend on the S&P 500, very short term. Now, over the course of the month, well, basically we're flat. We're where we were at the start of March. So generally speaking, this is a neutral chart, but we do have a little bit of a bullish move in the last week or so. Now, looking at that longer term chart, we talk about this every week, and there is that long-term upward trend line, and we've held that. We didn't quite pull back to it, but we have broken the flag pattern here on the weekly chart right there. And that points to this market wanting to go higher. So I think short term, it'll stall at the all-time highs. That's normally what happens. But in the weeks ahead, I think we're more likely to break out of that and continue along in that upward trend. Until this upward trend line is broken to the downside, remain bullish on the S&P and generally the US market. On the Russell 2000, which is the small cap, this is the daily chart, so a little shorter term view. And you can see that we broke to new highs last week, but we did that from rallying off of a low. It's not like we stalled at resistance and then broke higher. What we actually did was run right through it. And that means that you'll probably pull back, build a rising bottom, and then make another attempt at breaking out. Remember, this chart has been more or less sideways for many months, and this breakout was not an enthusiastic one. So I do think it's going to take a little more time for the small cap stocks to really break out of that range. Now, we are a step in the right direction, but still work to be done. Here's the chart of the TSX. You can see that we here are also basically where we were at the start of March. We had a pretty bad period there when the U.S. President Donald Trump started talking negatively about NAFTA and about the Canadian softwood lumber and dairy industries, and that sent the Canadian market down. It has not really broken support. It has broken this cycle of rising bottoms. You can see here we've got a low here that is lower than this one, and so that's bad, but not critical yet. Now moving along to the longer term chart, you can see that we've been stuck in the sideways range here. The upward trend line is just getting flirted with, and we could break down, and it would be a slight falling top if we broke down now. So I do think there's some extra risk in the Canadian market. I don't think it's critical yet, but what you want to watch for is, do we have a sharp move breaking the upward trend line? If so, I think this market's headed down into this range right there. TSX Venture, weakness in gold, weakness in oil has meant weakness in the TSX Venture market. It is still in a decent pattern. It could be building a pennant there, so maybe we bounce off of there and move back up. But if we break down through this support level, then it turns into a descending triangle, and it could be going into hibernation mode as we go into the traditionally slow time of the year, which of course is the summer. On the U.S. Treasury bond market, kind of not much to say here. We've basically come back to the downward trend line. We were oversold. We've come back to it. Likely should roll over and head lower there, but unless we break that upward trend line, I would be bearish or remain bearish on the U.S. Treasury bond market. But it could stall at the downward trend line and then break to the upside, which would mean interest rates going lower if it does in fact, if we do in fact roll over like this, then interest rates are going higher, which is consistent with Fed policy. So this is something you want to watch very carefully if you're in the bond market or if you're thinking about getting a mortgage, because this is an important chart for determining interest rates. On the US dollar, consistently got falling tops and falling bottoms as well. We are just starting to test down through there. It looks to me like the US dollar wants to go lower. We're in this downward sloping channel. However, the tops are falling quicker than the bottoms, which is something called a falling wedge pattern. When you have a pattern like that, what it means is that the sellers are getting less motivated to push that particular asset down. So if you get a break of that downward trend line, that's actually a bullish signal, even though this seems like a bearish pattern. Having said that, it's not bullish unless you get a break of the downward trend line. So for now, this is a bearish chart for the US dollar, but it does seem to be losing its momentum to the downside. On the gold chart, we, of course, came up to that long-term downward trend line. Didn't draw that very well, but kind of went just through it a couple of weeks ago. We're stalling there. We still have rising bottoms on gold, so it's still bullish in sort of this time frame, but in the long-term time frame, bearish. Will we hold and come back and try to test that downward trend line again? That's the critical thing. So it's trying to build a break of that downward trend line, but it has some work to do. So I would say cautiously optimistic with gold, but still cautious. Oil USO stuck in a sideways range. I like to show this longer term weekly chart because when I show a daily chart, it looks like there's lots of volatility. The reality is it's stuck in a very narrow range, kind of bounces around between 10 and 12 on USO. Kind of a dead chart, not a whole lot of action in that market, and so not much to be trading in the energy space. And the VIX, we talk about it all the time. The VIX will have these little spurts of life, and then they always roll over. We've seen it how many times. We are again at lows for the VIX, which means no fear. Complacency, yes, perhaps sets up for the market being surprised by weakness, but this shows that no one's buying insurance against a market correction. And until it starts to pick up and until it actually breaks the downward trend line, breaks from a rising bottom, I wouldn't get too worried about a sharp correction. So ratings then, bullish long-term on U.S. stocks, neutral short-term. Neutral on both times for the Canadian market. It is suffering a little bit worse. On the gold market, neutral on both time frames. It is trying to break that downward trend line, but it has work to do. Oil, neutral long-term, bearish short-term. It's been selling off the last week or so. U.S. stocks made good gains this week, but they are now hitting resistance where a stall is likely. Canadian markets lag, but have not broken down yet, although momentum is slowing. Gold is stuck at resistance at that downward trend line. Oil remains range-bound, and fear is really not a factor. All right, let's go on to the trade of the week. This is a day trade from Friday on Facebook. Facebook, a stock to trade because it triggered my action candle indicator on the 13-minute time frame. I'm not showing that chart here. I just want you to know why I had Facebook on my list for Friday. It traded strong volume, price gap up. So there was some abnormal activity that told me the market was excited about Facebook yet again. And then we have my message candle indicator, which is this little white dot there, breaking this downward trend line. That's my entry signal. And the market rallied on this one, 7RR, before rolling over. Now, typically for me, I hold these trades until the end of the day, and that would have given a reward for risk of 2-to-1. But there is something to be said about when you get up over 5, 6, 7RR to trail by 1. And that's how I've programmed the strategy on this particular trade. It trailed by 1 to get out at 6. Given that had such a sharp rise, sometimes you just want to lock in the profit on a fast mover like that. That was Trade of the Week on Facebook. All right, well, that's this week's Market Minutes. Please subscribe to the channel, tell your friends, leave a comment, and most importantly, trade well.